Welcome to the show. Today we're diving into an essential topic for any business, especially manufacturing organizations, how different costing methods impact inventory valuation and reported profits. The article we're discussing explains absorption costing, marginal costing, and even introduces throughput accounting. Rachel, let's start with the basics. What's the fundamental difference between absorption and marginal costing?
Certainly, Jake. The core distinction lies in how they treat fixed production overheads. Absorption costing, also known as full costing, treats all production costs, including a share of fixed production overheads, as product costs. This means these fixed overheads are absorbed into each unit produced and remain part of inventory cost until the product is sold. Marginal costing, conversely, only allocates variable production costs to products. Fixed production overheads are considered period costs, meaning they are expensed entirely in the period they are incurred, regardless of whether the products are sold.
So if fixed production overheads are treated differently, how does that translate into different profit calculations and inventory valuations, as the article highlights?
The impact is significant. Under absorption costing, unsold inventory on the balance sheet is valued at a higher cost because it includes a portion of fixed overheads. When these products are sold, those fixed overheads are then expensed as part of the cost of goods sold. This can lead to higher reported profits when production exceeds sales, as some fixed overheads are deferred in inventory. Marginal costing, on the other hand, values inventory only at its variable production cost, resulting in a lower inventory value. Fixed overheads are expensed immediately, making profit figures more directly tied to sales volume rather than production volume.
That's a crucial distinction for financial reporting. The article also points out that absorption costing is required for external reporting under IFRS and US GAAP, but marginal costing is helpful for short-term decision-making. Can you elaborate on why marginal costing is particularly useful for internal decisions, especially with the concept of contribution margin?
Absolutely. Marginal costing is consistent with the concept of contribution margin, which is calculated as sales revenue minus all variable costs. This figure represents the amount remaining to cover fixed costs and generate profit. For internal decisions, like whether to keep or discontinue a product, knowing a product's contribution margin is invaluable. If a product has a negative contribution margin, it's losing money with each unit produced, signaling it should be dropped or its price increased. Since marginal costing separates variable from fixed costs, it directly supports this type of analysis, helping managers focus on the short-term profitability of specific products or decisions. The article specifically mentions that marginal costing facilitates make or buy decisions and special order acceptance because managers can quickly see the incremental impact.
It seems that proper cost classification is foundational to all these methods. The article discusses direct versus indirect costs, and then production versus non-production costs. Can you clarify these classifications and how they relate to what we've been discussing?
Certainly. Direct costs are easily traced to a specific cost object, such as the materials and direct labor for an office desk. Indirect costs, or overheads, are common to multiple cost objects and are allocated rather than traced, like factory rent or depreciation of machinery. Production costs are those incurred in manufacturing a product, including direct materials, direct labor, and manufacturing overheads. Non-production costs are things like sales, marketing, and administration, which are always treated as period costs and never included in inventory valuation by any of these methods. The article emphasizes that both marginal and absorption costing start by distinguishing between production and non-production costs, but then diverge on how they handle fixed indirect production costs.
Understanding those layers of cost classification is key. Finally, the article introduces a third option, throughput accounting. How does this approach differ from marginal costing, and what makes it a more extreme version, as the text describes?
Throughput accounting takes the marginal costing concept a step further. While marginal costing treats direct materials and direct labor as variable product costs, throughput accounting considers only direct materials as a variable cost. All other costs, including direct labor, are treated as fixed overheads. This makes it an even more focused approach on throughput, which is defined as sales revenue minus direct material cost. The idea is that in the short term, most costs, including labor, are relatively fixed, and management's focus should be on maximizing the revenue generated beyond the absolute variable cost of materials. The article notes that this method is particularly useful when operations are constrained by a bottleneck resource.
So it's a very lean perspective on what constitutes a variable product cost. This discussion truly highlights how different costing methods offer distinct lenses for understanding a company's financial performance and making strategic decisions. While absorption costing provides the standard for external reporting, marginal and throughput costing offer powerful tools for internal management and short-term operational choices. Rachel, thank you for breaking down these complex concepts from the article.
My pleasure, Jake. It's a critical area for anyone involved in managing business finances.
Welcome to the show. Today we're diving into an essential topic for any business, especially manufacturing organizations, how different costing methods impact inventory valuation and reported profits. The article we're discussing explains absorption costing, marginal costing, and even introduces throughput accounting. Rachel, let's start with the basics. What's the fundamental difference between absorption and marginal costing?
Certainly, Jake. The core distinction lies in how they treat fixed production overheads. Absorption costing, also known as full costing, treats all production costs, including a share of fixed production overheads, as product costs. This means these fixed overheads are absorbed into each unit produced and remain part of inventory cost until the product is sold. Marginal costing, conversely, only allocates variable production costs to products.